Okay, you guys, this is being recorded, and yes, it is being recorded this time. Last week, there was a bit of a snafu going on, so I had to re-record it. And it was a good one, too, so I'm a little bit bummed. We had a lot of good back and forth during that webinar. I wish we could have kept there, but in and out having to reshoot that one. Anyway, like I mentioned, this is being recorded, and something I say at the beginning of every single one of my webinars, you guys, is watch this again. The reason why is because I'm not only teaching you how to build a strategy, which, you know, in the long put, it's really not that difficult, right? I mean, anybody can tell you how to go out there and buy a put. But what I try to teach is how to implement this strategy. There are certain ways and certain times that you can implement it, and there's certain times you should not be, absolutely should not be buying puts or buying calls for that matter. So I'm going to go over that in this webinar. And what I want you to think about is this isn't just going out there and buying a put webinar for an hour. This is how you implement strategies in the right time and everything else. Okay. So that's what we were trying to do here. Yeah, John, can you throw that out towards the end? I don't have enough. I'm not going to have enough time to read all that right now. All right. So, basically, we are doing the long put, but it's also kind of put that in the back of your head. I want to go through this like we are on any given day, kind of looking through the charts and stuff like that. And we come up with a directional bias. And then after coming up with that directional bias, we find the most appropriate strategy to put on that bias. Okay. So everything has its time and the place, but I do need to go over a couple of things real quick. My name is Wilkinson. You may recognize me from mainstream media. They used to call me the Wolfman, or actually still do, for my market commentary and everything else. I actually started out trading in college with a psychology degree and then decided, you know what, I'd rather do finance. And after graduating with that finance degree, I moved up to Chicago, never made a resume or filled out a job application. I just went on the floor, started walking around and asked for a job. Ended up getting a job and continued my trading career from there. Jumped up into the pits, and in that time I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products in just about all market conditions. Anyway, any opinions, news, research, and analysis, or other information should be considered as general commentary and does not constitute investment advice. The reason why is because I'm here to teach you guys how to trade. I'm not here to give you guys cherry-picked strategies and stuff like that. I'm here to do real-life trading, all right? So bottom line is, do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. The other reason why I don't sit there and say, hey, you need to go out there and do this strategy in your portfolio is because your bias might be completely different than me. You know, I mean, if you followed me on these daily market commentaries where I talk about all my trades, you know I'm pretty bearish on Tesla in general. And there's people out there that love Tesla. So if you love Tesla, by all means, do not listen to me, okay? So at least don't listen to my directional assumption with Tesla or whatnot, all right? You know, I don't hate or love on any stock. The bottom line is I'm just looking for opportunities and trying to increase my probabilities of success. So that's what I'm here to teach you guys how to do. You can also follow me on Twitter at Wolfman's blog and our parent company at Pro Trader Strat. We also have a Facebook page at Pro Trader Strategies where we push out a lot of content. You know, some of that being my daily market commentaries, like I said, where I go through the economic data and then talk about the markets and then talk about what I've traded, whether I'm taking it off for a winner or a loser, or if it's a loser, maybe how I'm trying to hedge that risk. Okay. So I'm doing real life trading in those daily market commentaries that you can follow along. Before we get into this, it is a pretty basic strategy, but you know, in that, the implementation of the long put, there's a lot that goes into it. And I want to go over some things that I'm going to be talking about. Some of these not so much, but we need to go over it. Options 101, delta is the effect of the option premium in relation to the underlying. And what this is basically referring to here you guys, is, if the delta is, 0.35, let's just say, which is basically the delta we're going to be kind of looking at with these puts. If the delta is 0.35, that means if the stock moves down $1, then our strike, the strike that we're using, is going to increase in value by 35 cents on that first dollar, okay? Now, gamma says basically it's the rate of change in delta, all right? So that means this is on the stock for the second dollar move. So this is on the, I don't know how to write this, second down dollar move, okay? And that gamma might be, let's say it's, 4 cents. So that means on that second dollar move, it's now the stock's moved down $2 total, right? First one, it increased by 35 cents. That means on the second down dollar move, this 4 cents adds into the delta. So now our strike price, the strike that we're using, that strike price is going to increase by a total of 39 cents, okay? So gamma goes with delta, all right? And it's on that second dollar move, all right? And theta is the thief, all right? Theta is the thief in the night that impacts our premium. And basically, the closer we get to expiration, he is going to steal more and more money from us, all right? So just think of theta as the thief in the night. And the reason why we have to know theta is because we are buying premium, and that value is going to go down by the amount every day that theta shows. So if theta says, I'm going to go down, I'm stealing 3 cents every night, the next day our premium goes down by 3 cents every single day. And the closer and closer we get to expiration, it's going to start ramping up. It'll go to like 4 cents and 5 cents. And Vega is the measure of change in volatility. And you might say, well, Vega is volatility. Well, what happens is that when volatility increases by 1 percentage point, all right, goes up by 1 percentage point, there's a thing in our option montage that's called Vega. And that Vega can be anywhere from a couple of pennies to, 30 cents. So if we look at volatility and our volatility number is, let's just say it's 30, all right, and this is in the option montage. As soon as it goes up by 1 percentage point, now it's 31%, all right? That means Vega has gone up by whatever that 3 cents might be to our premium, okay? So our premium will increase by that 3 cents, all right? And I'll go over that here in a little bit, much more detail. I just want to kind of get that out, get that into your head a little bit. And this is another reason why I say go over this again, watch this again. Because once we go through this entire webinar and you go back and watch this again, all of this stuff will sink into your brain. You will pretty much know it. It's going to, you are going to be able to remember it much longer, okay? So actually, before I get into that, I'm gonna just bring up the option montage real quick and show us what we're talking about in a little bit more detail. So this is what I was talking about. We have the delta, the gamma, the theta, the vega, all right? And we're looking at, let's look at an easier example with money. I'm just gonna go with EA Sports. Just because I don't want to be adding in $13 and all of that stuff, okay? All right, so we talked about delta. So when EA Sports goes from 98.34 to 99.34, right? $1 increase. So we go from 98.34 and now we go to $99.34. That means down here in the option montage, we're looking at delta on this first one. That $1 increase will make these premiums increase by delta. So they're going to go from $4.80 or $4.85, whatever you want to say, and it's going to increase by almost 50 cents, all right? So we're going to be looking at $5 and let's say 35 cents, somewhere around there, right? And vice versa on the put side, if we increase by $1, you can see delta is negative. That means if it goes up by $1 to that 99.34, these are going to decrease by the delta. So delta will come out of here. Vice versa, if we went from 98.34 to 97.34, right? The market went down by $1. Well, down by $1 to a negative, we got two negatives, so then it adds in. So if we went down by $1, these would increase. The puts would increase by the corresponding delta. And vice versa, if we went down by $1, a negative to a positive makes it a negative. So it would go down by the corresponding delta, okay? Now, if we are looking at quickly gamma, that was that second dollar move, all right? So $2, we can look at it. So now we're looking at this being at 99, let me just say on the second. So on the second dollar move, so now we're at 134 cents, right? So now we assume we're at 134 cents. Well, the first dollar move, we talked about it. Delta goes in there, 49 cents. We were looking at $4.35. Now, the second dollar, we have delta of being 49 cents, and the gamma is 3 cents. So that second dollar, our premium will increase by a total of equals 52 cents. Okay? So now our premium would be worth $4.87 on that if it moved up. If this increased by $2, all right? So gamma goes with delta on the second move. And the thief. Theta is the thief in the night that steals our premium. And theta is a negative on both of them because that theta, the thief doesn't care if it's a put or a call, all right? So what we're looking for, did I say $5? I meant $5.34. I may have said $4 and something. I meant $5. Increases by that 50 cents to $5.35. Yeah, the first one, we're going back to delta, $5.35. And then on the second dollar, we have that 51 cents. So on the gamma goes with the delta, we add in the 51 cents and get $5.86 on the second dollar. All right. So now let's go back to theta. Now that, thank you for correcting me because I will do that a lot. And please correct me. Don't feel afraid because I'm trying to think of the next thing to say and I'm not always clicking there. All right. Thank you, John. So theta is the thief in the night. So tomorrow we know that these premiums are going to go down by the corresponding theta because we know theta never stops. He comes in every day. So our theta every day is going to, or our premiums over here are going to decrease by that theta every single day. And the closer we get to expiration, theta starts getting a little more aggressive. All right. And then we talked about the vega here. So the vega, what we're talking about is here's volatility. It's also called vega. But when this goes to $35.93, if it increases by that 1 percentage point, right? I'm showing you that increase of 1 percentage point there. Then these premiums will increase by the vega. All right. So 17 cents goes in there. All right. Vice versa. If volatility goes up here, it doesn't matter what direction it's going. Volatility goes up. Then these premiums go up by the corresponding vega. All right. Does that make sense there? So basically the delta and the gamma change for the $2 move. Yes, will increase by the theta. Now remember, on the delta and the gamma, when we're talking about this, you have to add in that first dollar move, which is gamma. And then the second dollar move, gamma goes with delta. So then it also increases then again by that extra. So for instance, in this example with that $2 move, we can see that we got 49 cents on the first one and 52 cents on the second one. So on the second dollar move, if it moved $2 today, if we had a $2 move higher today, this premium would have increased by $1.01 today. Does that make sense? So gamma goes in there the first time, and then gamma and delta go together for the second dollar move. Okay? and will decrease by theta, increase by vega. Yes. If vega goes down, though, right, then we know vega is a negative, right? If this volatility, if vega goes down, I'm going to say if volatility goes down, that's a negative. So then it makes it a negative to all of these. So you got to remember, you know, your positives and negatives with this. It goes up by $1, gamma increases on the calls, and it's negative to the puts. Well, if it goes down, that's a negative to delta, and delta is a negative for the put. So a negative plus a negative equals a positive, right? And gamma always goes with the delta. It always adds in there on the second dollar move. You know, if it's a dollar move higher, that gamma is going to subtract out of the delta for the second dollar move. All right. So the second dollar move higher on these puts, the first dollar move higher, delta comes out of that premium. Well, on the second dollar move higher, gamma comes out of the delta. So that second dollar move higher here, it would have only lost 34 cents, right? Because 3 cents less the 37 cents, it would have only decreased by 37 cents, or 30 up from 37 to 34 cents. All right. And the volatility, I think we've gone over. So those are the basics, right? We've got that out of the way. Now what we need to do is we are going to look at what we need to be with this one, right? So we are looking at a directional assumption, and we are very bearish. All right. So that's the first thing we've come up with, right? So for instance, let's just say we go back to look at Tesla. I was looking at Tesla earlier. All right. Tesla, you know, I mean, we're just looking at directional assumptions, right? It's been in a bearish market, whatever the reason may be. I'm just looking at it like right here, you know, if you like to look at charts and stuff like that, one could say that this is a screaming top type of signal, right? You know, you get a doji that looks like this. I don't care what color it is at the top of a move, then that is, you know, as soon as you get confirmation, and I'm always earlier, you get something like that, doesn't matter what color it is, that is a pretty bearish indication, all right? Actually, if this was a green bar, it might not be so bearish, but you get what I'm talking about. You get a big move like this, a red doji at the top tomorrow, you get a doji that looks like that, sorry, I should have made that red. A doji that looks like that, then that's pretty bearish, right? So we'll just say right now, this fits with, I look at the charts, I'm looking at this, the way it's set up, that setup, I'm very bearish, all right? So let's just kind of go with that for an example going forward. And this is another case, like you guys may love Tesla, then I would not put on a long put in Tesla if you thought I'm absolutely out of my mind or that I don't know how to read charts, whatever. I'm more than entitled to have that opinion. So I've just come up with a bearish assumption in Tesla, very bearish. Now I have to understand, and right now, let's pretend right now we aren't really looking at it as the long put, all right? We've kind of forgotten that we're getting ready to do a long put. I just know that I'm very bearish. Now I need to think to myself, am I picking the right underlying? You know, I'm bearish in Tesla. Can I trade options? I know everybody and their brother talks about it on TV, but that doesn't always correlate to volume and open interest in the options. And the reason why we need volume and open interest in these options is because we don't want to have to give up a ton of edge to get in and out of these trades. We want to make sure that the options are tradable. You know, you can look at stuff like AutoZone. Everybody's heard of AutoZone. You see one probably every single day that you don't even really notice you're seeing them anymore. Or Aon. We've heard of Aon. May not necessarily know what they do as a company, but we know that they are big sponsors in sports and everything else, right? So those are stocks that don't have a tendency to correlate to good tradable options. Tesla, we need to find out if it's good. So my rule for this one, picking the right underlying, is we need to look at the underlying's option montage. And we're going to go to the ones that are closest, the option monthlies that are closest to expiration. You could say, yes, these Septembers are the closest to expiration. But the thing is there's a lot of people getting out of these options with 8 days to go. This is really like the rush out of, or the roll is happening where people are rolling out of these options and into the 35 days to expiration. That's usually where most people are trading, is this closest to 35 days to expiration. So this is where we need to go for this rule. And my rule is we move the decimal place on any stock over $100. Just move it 3 ticks to the left. You can see 24 cents then, right? If I move this decimal right here over from here, 1, 2, 3, now we have 24 cents, 24 and a half cents. So it's somewhere between 24 and 25 cents when I move that decimal. Now, what I want to do is come down here, and these options need to be 24 cents to the bid offer, okay? This is during open market operations, you guys. After the close, what happens when all our orders are in there? They get canceled unless they're GTCs. So most people will not be trading or leaving those orders in overnight. So you need to follow this rule during open market operations. And this doesn't fit that rule. So we're after the close. I can assure you 24 cents is a pretty tight mark, is going to be something that is feasible during the day in Tesla. But, you know, for this instance, I guess we'll have to find a different one. So let's look at Twitter. Oops, I got that off. Can I get Twitter? Can I buy Twitter? Let's look at Twitter. Let's look at the charts. All right, well, Twitter looks like it's had a bit of a top. Now, let's just say we're bearish in Twitter. Any stock under $100, we need to make sure we are looking at the option montage. It's less than 10 cents wide, all right? So that's our rule for under $100 stock, less than 10 cents wide down here in the option montage. Okay, well, we can see that that fits the rule. So maybe we'll use Tesla as our example for this. Now, this is the rule for just finding out if it's tradable. It doesn't mean we are necessarily trading the October expiration, all right? We're just looking to see if these are tradable by looking at the closest to expiration, the closest monthlies to expiration, 35 days to go, okay? We may very well be out, you know, in the 200 days to expiration to trade, but we're looking for this rule here. And the reason why is it's a good indication if there's a lot of people trading this contract that they're going to do the roll, and they are keeping an eye out here. Believe you me, they are watching these options out here because for hedging and all kinds of different things. Maybe they have a spread on and stuff. So they are keeping an eye out here further out on the duration. All right. So, but we're just looking for that rule here. Under $100, less than 10 cents wide, over $100, we are looking at moving the decimal. So if our stock is, you know, greater than $100, all right, then we need to move the decimal. So it's $100, $105 stock, right? Well, what we need to do is come over here and take that decimal and move 1, 2, 3, 10 cents, 10, 11 cents. So now, you know, we would say that would be 11 cents for that one. If it is less than $100 stock, then we're just saying it needs to be equal to or less than 10 cents wide. All right. All right. That's the rule for that one. Now we're going on picking the right environment. And I'm saying picking, we can kind of forget about the picking aspect. We're just saying the right environment, right? We need to make sure we have the right environment we don't even really necessarily think we're doing a long put yet, right? We're just bearish. We have to know that that might very well be the thing that leads us to the end of the day. But we don't really know at this point, right? All I know is I'm bearish in Tesla or Twitter. And I need to check out what the environment is. And what I mean by the environment, and this is absolutely paramount, all right? This is paramount to any of my strategies, is when I say the environment, I am specifically talking about volatility. And when I'm talking about volatility, I'm talking about IV percent. Okay, that means implied volatility percent. And what that is it just tells us where, say, Tesla is, or Twitter in this case, volatility is. Here's implied volatility. I have a little chart of it. Because 34 doesn't tell me anything about volatility for Twitter. It just tells me it's at 34. Everything on this watch list has different volatilities, okay? Now we could look at, just say XLE, and you can see the XLE, the very top gets into the 40s, but it's very low as 19. And we were just looking at Twitter, and the very low in Twitter is nowhere near 19. So that's why it's important to know where implied volatility is now in relation to where it's been in the past. Now, implied volatility, the reason why I use it instead of historical volatility is because implied volatility tells us what is implied for volatility going forward. And one thing about me is I'm kind of a contrarian, and I believe that when things are at their extremes, they are about to make a directional change. All right, you can see when it's down really low in and around this area, it has a tendency to want to rise. All right, it wants to go higher once it gets to these extreme lows. Just like when it's at extreme highs, it wants to come back to the mean. So what we're trying to do is set ourselves up for success. If it's extremely low, well, if it goes lower, it can't hurt us, right? Because in the back of our mind, we're thinking long put. So if we're thinking long put, I'm buying premium. I already told you if volatility comes out, that hurts our premium. If volatility comes into this underlying, if volatility starts rising here, if we start seeing it start moving up and start getting this kind of move higher, even from where I just started here, 34, to where I am right now in that little line, that's probably 10 percentage point increase. You can see the 40 is just above there. I could be at like 42, and that doesn't seem like but a blip on this little chart, right? But that's 10 percentage points. And you saw in my example where I was showing, even in Twitter, where we can look at this, Twitter, that volatility coefficient, I just said would increase by 10 percentage points. Well, 10 times 7 is what? 70 cents. That's a pretty darn good payday in and of itself, right? So we don't want to get caught in a situation where volatility comes out. We can't always avoid it, you guys. I mean, it's at extreme lows. It doesn't mean that it can't go lower, all right? But what we're looking at is, hey, it is super low. It's likely not to go a whole lot lower. Yes, it can go lower. I'm not going to lie to you. We can, but what we're trying to do is get ourselves in a situation where we are more successful. And when it's at extreme lows, we can tell it's probably going to revert back to the mean. All right. So we are looking for, in this sense, we are looking for low implied volatility percent. And when I'm looking at Twitter, so the right environment, when I'm looking at this, we need to come up with implied volatility percent, all right, which is what I was talking about. You can see it's over here on my watch list, implied volatility percent. And the way that it comes up with that number is basically, it's probably the simplest math problem you'll ever come up with. And basically we need three points. We need the high, which is 90, the current 34, and the low we said is 20, let's call it 27. So 90, 34, 27. So let me just write this down real quick. I've got 90, 34, and 27, right? Those are the 3 points. And for the implied volatility percent, we need the current IV minus the low IV. And we take that sum and divide it by the high IV minus the low IV. Oops, low. I'll just write it out. Low IV. IV. All right. So let's just punch those numbers in. The current was 34 minus 27. That gives me 7, right? That equals 7 there. And we divide that by the high, which was 90 minus 27. So that gives me 63, right? So 63 goes into 70, or 63 goes into 7, or 70, 1, and that leaves me 7. So it's like 11, right? Somewhere around there. It's going to be like eternal 11. So that means I'm at an 11 implied volatility percent for Twitter. The right environment for this, we are looking, the lowest we can get is good. Anything, any IV percent that is less than 30 is what we're looking for a stock. All right. Stock, we want our implied volatility percent to be less than 30. For an ETF, we want it to be less than 15. And why is the ETF got a different coefficient? It's because there's about 25 plus stocks in there. All right. There's 25 plus stocks in that ETF. And all of these volatilities are going to kind of meld out each other. Kimlin, I see your question in there. I'm just dreading trying to read all that while I'm trying to keep everybody else occupied. So I'll try to get to that when I get a minute, but I don't want to get too far away either. So give me a second, you guys. You can own put options on a company X or XYZ after a bearish technical setup. Now, X says it is liquidating itself. Now you know why you seem to be the only person clicking sell or buy on the options panel. Now what? Well, if they were liquidating themselves and you had bought a put in there, then it goes basically to zero. I think you would basically have where you bought the strike to zero, right? Is there any good way out of this? You'd have to probably let those expire and, you expect or the price to go down at some point. Yeah, I would expect the price to go down. If the price is going to go down for that stock. Could go up though too. I mean, sometimes it could increase in value because they're saying they're getting a lot of fat off the books too. It's going to really be dependent on that. I'm going to have to think about that a little bit more. All right. So the right duration. All right. The right duration on this is we want the time. We want time to be on our side. All right. So we want a lot of time on the calendar. So we want to go further out on the calendar. Why? Well, there's a couple of reasons why. When we're buying premium, this is theta. This is that thief in the night that comes and steals our premium. And yes, you could say these are at the money. So the theta curve is a little bit different for every single strike. And I'm picking the ones that are at the money. Yes, I am, because it's the easiest one to give us a representation. Now, I told you everybody's in 35 days to expiration. And you may think, well, let's go in there for liquidity. Well, this is where the thief starts getting aggressive. You remember I said everybody gets out at around 7-8 days, and this is wise because premiums really take a tank. So we want to stay out of this area here. We want to get out here on the curve, somewhere I kind of like to go in this area, all right? I don't want to get in here too close because I get in right here and I only have a couple of days before that thief really starts picking up steam. So I'm kind of wanting to go out in this area where we have the thief only taking like maybe say 2 cents out of here, and in here it's probably, you know, it could be 5 cents a day. All right. So I want to stay away from that scenario. I want to get further out here where theta really isn't hurting me as much. And because I'm buying something, I want to give myself enough time to be right. Okay. I want to give myself enough time to be right. So we want to get out on the curve. So on the duration that we were talking about here, oh, it's not one. Let me do it. The duration we want to have greater than the duration we want to have. So it's the marker. So that's what I think happens sometimes. I've been trying to figure this whole thing out on why sometimes it works and sometimes it clicks on me. But we want to have the duration be greater than 35 days to expiration, right? And the sweet spot, we probably want to be even actually greater than 50 days to expiration, right? So go out on the curve. We want more time to be right. All right. And then picking the right strikes. All right. Now we're getting to some of the nitty gritty here and the exit strategy pretty soon. The picking the right strikes, we're going to be looking at trying to do somewhere between a 45 and 35 delta. All right. And I kind of went in a little bit, but that's going to be the 30, and those are out of the money. I don't do in the money options when I'm buying them. All right, guys, I don't want to deal with that. Plus, this is a lower probability strategy. So why pick something that's in the money and I still have the same theta decay and all that other stuff? I have to pay so much money. And if I'm directionally wrong, then I lose a lot of money, right? What we're trying to do here is set ourselves up for success. If somebody's telling you to buy in the money puts for a bearish directional assumption because you want to avoid theta and all that stuff, well, you know, I would say stay away from that, because if you are wrong, you're going to really get hurt. And what this is saying, if we're picking a 35 or 45 delta option, you know, delta not only tells us what it does to the premium, you guys, it's also your probabilities. All right. It's also a % probability of finishing in the money by 1 penny. Our strike, if it's a 45 delta, is saying that there is a 45% chance that your strike will be 1 penny in the money at expiration. All right. 1 penny in the money. It's 45% chance. Okay. Now, one thing that is a floor trader hack that you aren't going to learn anywhere else, and this has to do with implementation and exit strategies and stuff like that, 2 times the delta equals your probability or the chance that I'm going to get what we used to say on the floor is to get kissed. All right. You get 2 times the delta is the probability of getting kissed or getting touched. That means the market moves around like this. It comes down to my puts right there. It hits my strike location. Well, that's because it's a 90% chance that that's going to happen, right? I want those probabilities, but there's only a 45% chance or about a 50-50 chance that it's going to finish in the money by 1 penny at expiration in this entire duration we're in this trade, right? So we got to play the probabilities here, and the probabilities being in our favor when we get kissed, like we never get kissed, then we take that opportunity, all right? So once we got 2%, so we want to increase our probabilities of something happening. And then our exit strategy here, you guys, is when our premiums, when that strike premium, when our money goes up by 50%, all right? So for a quick example, if my, let's say my $50, the $50 puts, that we're doing the 50 strike puts, cost me $1. I paid $1. Once this increases in value by, goes up to $1.50, that's when I'm looking to get out. All right. And probability is, or it's probably going to happen if I have those puts on. Remember I said your probability of touch is 2 times the delta. Well, if it comes down and hits my 50 puts in the duration, I have probably seen that increase happen, right? We're playing the probabilities. If I can increase my probabilities of success, that's what I'm going to do. So, one of the things we're doing here is picking the right underlying, or just the right underlying is when we have that decimal move, right? $150 stock, we move it 3 ticks left and 15 cents, or equal to or less than 10 cents on any stock that's below $100. The environment is we want a very low IV percent, all right? And we want that to be less than a 30 IV percent. For an ETF, we said less than 15%. And I would even say, you guys, if you haven't traded options very much, or maybe you haven't had much success with trading options because you're listening to some guys on CNBC that are always just like buying options and willy-nilly. They don't care about this volatility coefficient really, all right? Well, if you've gotten burned a couple of times and you're a little bit worried about getting your feet wet, start out here. Start out with super low volatility percent, less than 15%. And then slowly maybe ratchet that up. You start getting comfortable with that. Hey, I'm having some success with that. Well, maybe you increase it to say, I'm going to do stocks with less than 15 or 30% now. So try and increase your risk parameters that way. And we talked about this, the duration we need is got to be greater than 50 days to expiration. And I think that the sweet spot is going to be, somewhere in between, 50 and let's say, 100 days. I don't like to go much further out than 100 days. So somewhere in between those kind of things. And our exit strategy is when we increase by that 50%. Our money increases by 50%. If it was $2, we paid $2. When it goes $3, that's when we're looking to get out. All right. But on the floor, just remember, when the strike price, if you have a really high risk tolerance, on the floor, we said, if you put on the bull, or if you put on the put, long put, you are more bearish than a matador kind of thing. And that if you are more bearish than a matador, then maybe you want to do it to where it doubles. You get 2 times the premium. 2 times the premium are out. So in this case, we looked at $1 and you're getting out. You have a really high risk tolerance. You're getting out when it's at $2. I don't have a problem with that if you have a high risk tolerance. Okay. So let's go over our max profit here. Oh, wait, one other thing. Be aware of the dividends. It's not it's not a major factor here. Just know that dividends will lower or theoretically lower the value of the stock on that ex-dividend date. All right, that can help you with the puts. It doesn't always go in that direction. There's several times it doesn't. All right, so be aware of those dividends. All right, your max profit, I say unlimited here because it's going to feel like unlimited, and that's when the stock goes to zero. I am never going to ride a stock to zero. I don't know if I've ever seen a stock that I had on go to zero. It's just almost never going to happen. Don't even think about it. Think about this as we're looking for an exit at an increase of 50% in premium, in our premium. All right. just know that's where you're looking at. Your max loss is your premium paid. All right. We can't lose any more with this debit spread than that premium we paid for it. So we paid $1, we could lose $1, right? I usually, with debit spreads, especially of this nature, I'm going to ride them out till the cows come home. If they're a loser, if I bought a put and the market starts rallying, at the end of the day, you know, I have friends that have time stops. All right. You know, I put a put on, you know, I'm getting out in 5 days, no matter what, if it's not going in my direction. I also have people that will say, if my premium decreases by 50%, I'm getting out. I like to play the probabilities out. One thing though, if, you know, for instance, we were looking at these things where we had a technical setup. This is where I'm going to, you know, differ a little bit. If I did this on a technical setup like this, and I put it on today, like I'd probably put this on tomorrow, even before I got a confirmation here, you know, I would get out as soon as it trades above that area there. I would be like, okay, I got in for a technical setup. And if that technical setup doesn't follow through, then I'm out of it. Okay. So your exit strategy, on a losing trade, it may very well be different. All right. So somebody said they were short CBIS last week, and it no longer traded at values is 0. That would be a nice trade. Never happens. I'm never that lucky. But you know what? I feel there is no luck in this game, you guys. You don't get lucky. And that goes with life as well. If you put yourself in enough opportunities, some of those opportunities are going to work out for you. And I will see, that's when everybody notices, and then they say, oh, you got lucky. No, they didn't see that starving artist, the one-hit wonder, make 1,000 songs, and then the one song makes it big. Well, they got lucky or whatever. No, they put themselves in an opportunity to be successful, and they were. And just like that. So a technical setup breaks down. I will get out, you know, on that exit. All right. Otherwise, you know, if I just wanted to do a delta adjustment to my portfolio, which I often talk about in my daily market commentaries, you know, like my portfolio gets too one-sided. Well, I want to do a delta adjustment to my portfolio. I might go in and buy some puts and just really not have a great theory on why I think this thing should go down, but I need to put some negative deltas in there. Those are different circumstances. All right. So, and I don't have the time to go over, unfortunately, all of those different scenarios. So knowing how you trade, you know, if you're a trader by technical setup, however that may be, whether it's the Fibonacci or any of that stuff, if it breaks that pattern, then get out. Don't try and play the probabilities anymore. If you're doing it for a delta adjustment or other reasons, then maybe I'm going to ride that into the max loss. All right. The problem with getting out on a loser is I don't know what your risk parameters are, you guys, and it goes back to that. And I can't really tell everybody to do something when I don't know the risk parameters. I would have to know what kind of risk parameters you have. All right, so break even is that long option plus, or in this case, it's going to be, we paid a debit. It's going to be minus the premium paid. All right. It's going to be minus that premium paid. So, you know, like in that example I was saying, we did a $50 strike and I paid $1 debit. Well, then when the underlying is $49, that's my break even. All right. And you'll be able to achieve break evens with volatility expanding and the underlying doesn't even go anywhere. You can actually see yourself make money in a situation like that. I can give you a perfect opposite example of something that I was just talking about in the daily market commentaries. I don't have the underlying up here, but let's just look at it. It's Ulta. Oops, not Golta. Ulta. All right, so the other day, so we had an earnings in Ulta, and then you can obviously see it did not go very well. All right, the market slammed down. Here's your volatility, right? Well, I was looking at this like we got slammed down, and usually you see a big volatility crush after the earnings, right? Well, we didn't get that volatility coming out here. It actually kind of started increasing. And I was like, you know what? All the news is out there. There's nothing else to trade but a bearish signal or that I think it's going to bounce. And actually, I put this trade on 9.3. I didn't see the volatility come out. It actually increased. And I said, you know what? It came down to this support level. And, you know, there's a nice bottom here. Maybe it's very close to tweezer bottoms, all that stuff I was talking about. You know, so I actually thought we were going to bounce up and away from here. So I said, let's go out, and we are selling shoot, what was it? I think it was the 195 puts. So I was like, I'm going to sell. I can't pull it up right now. Why isn't it? Where'd everything go? I'm doing the 195 put. So basically, I said with Ulta, where's our trade? Ulta, I'm selling the 195 puts for $1.35. Okay, so I'll just write this down. And hold on. Let me get all this stuff out of here. Out of my way. Make sure it's not going to click off on me. So I'm looking at these where I was like, we are going to do the Ulta 195 puts in October. So I went far enough out. So I was looking at the October 195 puts. And I sold them. I sold these October 195 puts for $1.35, I think it was. I talked about it today and I can't remember anything. So October 195 puts. So basically, you know, I'm way down there. I don't have to worry a whole lot. Well, what happened? I was directionally wrong. This market went against me the entire time I put that trade on, right? But what happened here? Volatility came out. It basically came out from, it was like 45 or something like that, all the way down to 30 where I got out today. So that was 15 percentage points coming out of that underline. So that directional move of me being wrong by from, let's say it was 235 all the way down $10 move against me in the wrong direction. Yeah, they to help me out. I was able to get out for 65 cents today. All right. And that was 50% decrease in the value of my, I sold the put. I sold it. So I'm giving a complete opposite example, John, here to try and give you the reason why, you know, if I was bearish to not buy these puts in a situation where we had high implied volatility. Because had I bought it at $1.35, right, on this day, even if I was bearish, like, hey, this is still going to go down. Like, that was just terrible news. You know, it's going to go down, down, down. Well, yeah, it did. So I could say, you know, I bought it at $1.35. Let's just say I bought it at $1.35. I got the directional move correct by $10. You know, I was $10 right. That's a good directional call, right? But what happened? Volatility came out. And I would have lost money. I would have been looking at, like, I was brilliant, but I didn't know how to implement it. So that's why I say, yeah, you can know how to do a strategy. Anybody can teach you how to go and do a strategy. And guys on TV might have been going out there, unusual option activity, you know, it's going down to here. And yeah, you got your directional move right. As a matter of fact, a couple webinars ago, somebody was talking about a move in Costco, and I haven't even checked Costco in a while. And I basically called it out on Twitter and everywhere else in my daily market commentary and said, listen, I'm doing the opposite trade of this guy. I believe his directionality. He's a pretty smart guy. I believe in his directional assumption. But his strategy implementation is garbage. And he was saying buy calls, and I said you sell puts. And what happened? The market started moving higher. Volatility came out, and it didn't move much higher. It wasn't very strong of a move higher. I don't think it made new highs or anything like that. But me not having any directional assumption, but just kind of going with it. I sold puts in high volatility. The volatility came out, and I won. In the meantime, his were going sideways. The volatility was coming out, and they were losing money and not knowing why. So this is an example of why implementation is paramount. So I don't care if you know how to build a strategy or iron condor or broken wing butterfly. Implementation of that strategy is paramount to your success. Okay? So, that's that. If you come away with anything at all, that's what I want you to know is I was directionally wrong here. I was a potato and didn't know anything. And of course I was wrong and too stubborn to get out, but volatility was my friend. It just kept coming out for me. Theta was helping me also, but theta way out in October, which is kind of the sweet spot right now, but it wasn't that much of a factor. I mean, it was a couple of pennies a day, but, over 5 days. So it did help, but ultimately it was the volatility coming out. So make sure, when you're doing this, you set it up with that low volatility so that when volatility comes back in, you may say, well, if the market goes up, volatility comes out. And that's what a lot of people believe. Well, not necessarily. Volatility can spike, and it is a product of people buying premium in the options. And yes, when people are panicking, they're going out and buying puts, and that's usually what drives volatility higher. So we normally see that skew to the put side because they're protecting their portfolio of stocks. So that makes sense. But when people have FOMO, fear of missing out on a move, then they have a tendency to jump in on buying call options, which drives volatility higher on both the calls and the puts. So, you can be directionally wrong and still not get hurt. Volatility crush would have dropped the premium beyond what we would have gained from the bought the put is what you're saying. Yes, the deltas of that directional move were not making up for the volatility crush coming out. So you would want to get into something with really low volatility. And, yes, volatility can come out, but it's not going to come out in clicks of 10, right? Like we saw in some of those examples I was showing, when volatility is getting crushed, volatility's, this is getting crushed. In Twitter, you can see what I was talking about. When it gets way down here, it's not going to go down 10 more points. Well, I mean, it could. Don't get me wrong. I never say never. But you can see it rarely goes below here. And I could probably pull up a 3-year chart on it or 20-year chart probably even. And you can see, yeah, it does. It has gotten down to 28, 26, but there is nothing below that too much. So we're talking 5 percentage points. Whereas right here, we're talking, it went from on a earnings from 55 down to, 20. So 25 percentage points in a day. So that's why you never buy options ahead of an earnings. And there's guys out there that'll tell you to do that all day long, but you can see this. I don't care how directionally right you are, that volatility crush coming out is going to hurt you bad. All right. So stay away from that. Sorry, I got a tickle in my throat all of a sudden. You guys have any other questions really quick? All right. This is a great special, you guys. This is one of those unicorns that shows up every once in a while. You get all 4 of these courses for $297. So each one of these courses are valued at over $1,000 each easily. So, or right around $1,000, I guess, now that I look at it. So you're getting all of these courses, 4 courses for under $100 each. That's the Volatility Crush course. this is great. If you want to take advantage of volatility or really understand the most paramount thing, we almost never give deals on volatility crush alone, and it's packaged into this deal, so it's worth it in and of itself. And then the floor trader hacks. It's basically easy ways to learn right things to do before you're trading. Those the theta and the thief help you remember those kind of things, right? A bunch of 5 different things that volatility will tell you. 9 different floor trader hacks that we had. All right. Those will streamline your process. Volatility crush is going to avoid getting smashed under a rock. The floor trader hacks is going to streamline your process. If you are newer to options trading, even if you've been around for a while, I'm going to make options a little bit more easy to understand. Basic things to help you understand that. Like, I can't go into all of them right now. As a matter of fact, I'm drawing a blank right now on some of them. And the fun ones, because I'm looking at history of options. I go into the history of options, who the first person was. As a matter of fact, Socrates wrote about the guy that first invented options. So, it was a long time ago. And how to trade like I do, basically implementation. This is how you implement your options into your portfolio. So it's, you are able to take full advantage of everything, right? That you can be directionally wrong even and still make money. So take advantage of this for $290, $297, sorry. I have that hot link in the chat window. We've been going back and forth in the questions box. If you flip over there to the chat window, there is a link that will pull up a new trading window like mine just did. Onto the wrong side over here, but you can see that it will pull it up like this, and you can take advantage of that. So for $297, each one of these basically $1,000 each. My window's kind of covering up the last one. Also, if you want to take advantage of this and you're watching it on tape delay, you can call us at 310-598-6677 or trading@protraderstrategies.com. This is also the link. If you're watching it on tape delay, you're going to have to pause it. And yes, John, you can ask something. I'll get to that in a sec. And then finally, I want to thank you guys all. I'll answer more questions after I'm done with this whole spiel. Thanks again. Here again is the option premium. Whoops. That's not right. Back. There we go. This is the one. I was trying to get to this one. Floor trader hack for $297. All right. What do you got there, John David? All right. Can you give me one of those reliable persons? Yes, I will. I think you have. Well, last week, so anybody that was frustrated with last week's webinar, not getting it on time, you guys, that was a product of, as we all do better with our products, we've done better with ours where we've streamlined the process where when you watch a video, it's much easier to tell how much you've gotten through it and the check marks that have already seen it and all of those things. We've streamlined the process. If you had this entire course, like what you've watched, and make it easier for you. Go to meeting or go to webinar has done the same thing where they think they've streamlined the process, but in the meantime, all of us have to learn how to work it again. And what happened was last week during that whole snafu, it bumped us off of recording it. So I had to actually record that last week. So I actually just got done with it yesterday. I hadn't had time to do all of the other things. I had other things. So I just got done with it and sent it out yesterday. So you guys might not have gotten last week's, and that was a problem. We have this one recorded, so hopefully it should be able to get out to you guys relatively quickly this time. All right. And Kim, I think I got your question. Richard, good to see you. Thank you for the kind words, man. Great to see you. All right, that's it, guys. Take advantage of this. Without any other questions, I'll get going and let you guys go. But again, at the top here is where we have the link. If you're watching it right now, you guys should take advantage of that, especially we just got out of earnings season, coming into earnings season. The Volatility Crush can help you with that. And if you love just trading earnings or want to learn how to trade earnings, we've got a webinar for you there. Make sure you check out the daily market commentaries where I talk about all my trades every single day. You can follow us on Facebook. Like I said, you'll be able to get those. That's where I talk about implementation quite a bit. So take advantage of that. Ted's in the house too. Good to see you. Thanks. Thanks, guys. That's all I got. Other than if you can't take that, take it easy. Bye for now.